Namaskar, hello, hola, marhaba. I'd like to welcome you all to this live webinar by Page 360. To begin with, I'd like to thank all of you for attending this webinar and taking out your precious time. We would also like to thank our webinar partner, Virtual Studio, for live streaming this video. My name is Kanika Miglani, and I'm the Head of Marketing and Client Relations at Page 360. And today I have with me Mr. Amit Goyal, who is the co-founder and chief global strategist at Page 360. He co-founded Pace Group in 1995 and has focused his energies on researching global asset classes and financial markets since then. He has been keenly involved in advising large corporate houses and family offices on their asset allocation strategies. His articles and newsletters on financial markets and spirituality are very well known. Amit is also a familiar figure on TV, where he has appeared on various business channels for his views on global financial markets. Today, we wish to talk about the global revolutions and historical developments in the world of finance and investments, and how Page 360 can help IT professionals to be on the right side of these revolutions. We are glad to have your participation in today's webinar. To make the session interactive, we shall open the question and answer session, that's the Q&A session, right after the presentation of Amit. To type a question to us, you can use the question text box which is right there on your screen. Just type your name, location, and click on the submit button to send the question to us. Now I shall hand over the session to Amit for his presentation.
Thanks, Kanika. A very, very warm welcome to all our participants from all parts of the world. We are really grateful to you for giving us this opportunity to be a part of this and to be able to share knowledge and consciousness with all of you. Thank you so very much. And now straight to business. We are indeed in very, very exciting and interesting times from a financial perspective. And there are a lot of things which are happening in this world of finance, which are either happening for the first time in a generation or in many cases first time ever in history, which makes the entire landscape extremely interesting and exciting. So, it's probably the most exciting time ever to be an investor, to be a wealth manager, and to be a fund manager. But what is more important is that while it's extremely exciting and interesting, this also poses a very, very serious challenge to us while we are trying to do our respective jobs as investors or fund managers or wealth managers. And it sometimes feels a little scary because it just seems that the line between brilliance and mediocrity has never been wide enough, and the results are never going to be stark enough. So basically, those of us who are on the right side of these historical changes and these watershed developments, they will probably laugh all the way to the bank and probably, spend their retirement in Caribbean soaking the afternoon sun. And for many of the others who are not on the right side of the history, it's probably going to be much less fortunate than that. So it is with that sort of a mind state that we now get into this webinar. We will be sharing some slides with you, and the first slide is about the historical developments and the watershed changes which are happening in the world of finance. So this has been already the longest bull run in US history. It's been 10 years and counting. So while this is great news, but then a challenging question would be that what happens after the longest bull run in history? Is it a short bear market, or is it going to be a long and a painful bear market? That is a question we should all be asking ourselves, as well as our wealth managers and fund managers. Similarly, this is also the longest expansion in US history, which means that we have to seriously introspect and think about what's going to happen after this. Is it going to be just a slowdown? Is it going to be a recession? Or God forbid, is it going to be a long recession? So, these are the questions which we would have to ask ourselves and our financial advisors. the world is drowning in $250 trillion of debt. This is absolutely the highest ever, both in the absolute sense or in a relative sense as a percentage of the world GDP. This effectively has two implications. One, there are going to be lots and lots of distressed opportunities in the time to come, because there are going to be people who will find themselves horribly over leveraged, and they would have to deleverage themselves, and sometimes it would present us with some amazing opportunities to buy long-term assets at very, very low prices. But then the question is whether we would ourselves be in distress and whether we would be selling assets at those distress valuations, or would we have the kind liquidity and cash available to actually opportunistically exploit those distress opportunities. The other side of this $250 trillion conundrum is the liquidity part. There is literally trillions, hundreds of trillions of dollars of liquidity which is sloshing around in this world, which means that because of this concept of benchmarking, we are always, for every single asset class, we are either in a massively overbought situation or in a massively oversold situation. So either we are all investing in a certain asset class, so we make bubbles of overvaluation, or none of us are investing in that asset class, leading to bubbles of undervaluation, which is then corrected by a bout of equally severe bubble of overvaluation. So the most recent examples that come to my mind in this is that last year, around September and October, the US 10-year bond yields were quoting at about 3.26 for the 10-year. And it was as if the whole world was despising that asset class, and there was literally no money flowing into that asset class. And that was the time we took a contrarian call, and we believed that the upside in the yields is very, very little, and we actually made it our best investment idea for the rest of the year. And as you believe it, that same yield of 3.26% went down to as low as 1.6% yesterday. And yesterday, after a very long time, we felt that US 10-year treasuries are actually now in the process of getting overbought and overinvested. So it was only last night Indian time, that we actually gave a sell signal on the US 10-year bonds, and we asked our clients to gradually offload them in the in the next few days and weeks, and not just the 10-year bonds, but all asset classes which are sort of connected to the US 10-year bond yields. So in a matter of 9 months, we have seen a horrible overvaluation, and we've also seen a horrible undervaluation, which was last year. So similarly, in gold, for example, in the month of April and May, we spotted an opportunity where we realized that almost everybody has fallen out of favor as far as this asset class is concerned, and everybody despises gold. And all our macro indicators were telling us that gold actually is going to be a great asset class, both for the near term as well as for the longer term. And as luck would have it, from a level of about $1,270 odd an ounce, yesterday it made a high of about $1,520 an ounce. So I wouldn't say that gold is already in an overbought situation, but look at how dramatically the market has changed its course, and from being the most despised asset class of the last decade, suddenly it has become a flare of the town. So this is what this $250 trillion of debt and this $250 trillion of liquidity does to us. This is, while it is extremely exciting, but obviously it poses as big a challenge as it is exciting for us as investors. The next point, there is a complete breakdown of the relationship between the labor market and inflation. So there was a time when all of us economists, we believe that whenever the labor market is going to be hot and unemployment is going to be low, inflation is going to shoot up. But look at what is happening. In most of the countries in the Western world, particularly in US, the unemployment rate is at historical lows. It's like at about 50, 60-year lows. And still there are no signs of inflation. And if you ask any normal 10 investors whether the likely scenario next would be inflation or deflation, I can safely tell you that more than 70% will probably say deflation than inflation. So this is happening right at the time when the economy is red hot and the unemployment is practically at its lowest ever. So all these pose conundrums for us, because normally these kind of financial and economic parameters are associated with an economy which is sort of slowing down. This absence of inflation, buffers in the form of lower commodity prices. So all this we are used to seeing mostly in times of slowdown and recession. But this time we are seeing it absolutely when the employment market and the overall economy is red hot in most parts of the world, not all, of course. So the question that we would have to ask ourselves and to our fund managers is that when the scene changes and when the economy is not so hot and when the unemployment rate goes up, then would the load single digits of inflation, would it mean that are we going into deflation or are we going to worse than that? So this is a question that we need to ask, and all these questions are happening practically for the first time in at least a generation, if not the history overall. Our next point, the global interest rates are extremely low, again something which is associated more with a economy which is slowing down rather than an economy which is running at full employment. So this is never before in history, and never before have the yields on so many different government bond yields in all parts of the world have gone into negative. Right now, 35% of the government treasury bond market of the world boasts of negative absolute yields. And if I were to talk of real yields, then about 60%, 60 to 70% of the total government debt in the world is either at negative real interest rates or practically zero real interest rates. So effectively, what that means is that usually in a slowdown or a recession, the interest rates move down, and the central bankers of the world are already taking down the interest rates. If the interest rates are already in the negative and the unemployment rates are expected to go up in the future because they cannot go down much from these levels, then what is going to happen to the interest rates? So is it that from -0 or -1%, are we going to move all the way down to -2, -3, -4? That would certainly be something which, as an economist, I would be extremely uncomfortable, because if the interest rates go too much in the negative, people would actually take money out of the bank and put it under their mattress rather than pay negative rates of interest in the bank. So these are again questions which we constantly need to ask ourselves. Then the next point is about the fiscal deficit. The fiscal deficit situation for most of the governments in the world is something that we usually see in recessionary times when the governments are bump priming their economies. This time, at the height of an economic boom or close to the height, when the unemployment rate is at its lowest in US and very, very low from a historical perspective in most of the Western world, if in such a time the governments are running high fiscal deficits, so how would they pump prime their economies if the economies were to turn turtle? Again, a billion-dollar question. So effectively, because of all this, what has happened is that if and whenever the world goes into its next slowdown or a recession or, God forbid, a depression, then the governments of the world are absolutely, they'll become defenseless after a point, because they would not be able to increase their fiscal deficits and their tax collections would go down a lot more. So even at the current rate of expenses, they would have more deficits. So are they going to completely monetize all their debt? And what would be the implication of inflation or a prospective hyperinflation if that were to happen? Again, a very serious question to ponder about. Look at the trade war situation in the world today. In the last 100 years, there are only 2 times that we've seen trade wars like the ones we are seeing right now. The previous time was in 1980s in the Reagan era. when US was just coming out of a recession, and in order to protect the American jobs, and the Japanese and the Europeans were exporting automobiles into US. So in order to protect the jobs, the employment and the economy, US under Reagan, they started trade wars, which resulted in a Plaza Accord. But this time, it's radically different. While last time they were doing this to protect their jobs, this time it seems it's more a matter of egos, where governments are doing this basically to be one up and to score a victory at the expense of another. So historical experience tells us that there is going to be no accord this time, like Plaza Accord, which ended the trade wars in 80s. And if there is no accord, then where would trade wars lead us? The last time, and which is even more scary, when trade wars were happening at this scale, was in 1930, just after the Great Wall Street crash of 1929. And in that case, there was an act which was passed, which was called Smoot-Hawley. And under that act, US imposed huge amount of duties on practically goods from all over the world. And what happened subsequently was a 66% fall in the global trade and about a 40% shrinkage in the US economy over the next 3 years as part of the Great Depression. So this is how serious a trade war situation can be for the future of the global economy. Now, of course, it's pretty scary to think about 1920s and early 30s. But the idea is not to scare you. The idea is to force ourselves to seek answers to some of these questions from ourselves, from our fund managers, from our wealth managers. God forbid if the Titanic has to sink, then we would rather be in a small boat watching the spectacle from outside rather than being on the Titanic ourselves. So this is what this entire effort is all about, to try and make ourselves one up and slightly better off when actually the situation turns for the worse. And at that time, we should be more prepared than practically anybody and everybody apart. We should be more prepared to handle that situation, but it can only happen if we start asking the relevant questions now. Last point on this is Brexit, which is of course pretty commonly understood, but then Brexit is something which is unparalleled, at least in last 100 years. We haven't seen this kind of a development any time in recent memory. And UK, while of course not the center of the universe as it probably was till a few decades back, but still it's an economy, it's an important economy, it's an important business center, it's an investment hub, it's an investment management hub. Last time when the economies were slowing down, pound was 2 to a dollar, more than 2 to a dollar, and right now it's about 1.2 to a dollar. So it just tells you how much things have changed in the last 10 years, and Brexit has obviously done its part to sort of act as a disruptor in the economic and in the financial context. Now we move on to the next part of the presentation, which is about the revolutions which are happening in the fund management industry. So here, of course, there are quite a few changes which are happening, but we want to highlight only a few so that we do not take too much of your time today and right now on this. So one is the prominence and the proliferation of ETF products. So in 2007, just before the previous financial crisis, ETF industry was a small fraction of what it is today. It was more like $1 trillion industry. It has grown to about $7 trillion in size, and it is attracting more and more money by the day. ETFs, as you would all know, are a much lower cost product than the traditional fund management products, which can cost you anything from 2 to 3%. An ETF can probably cost you as little as 0.1 or maybe going up to maybe as much as 0.5, 0.6. So this movement from mutual fund to ETF is probably one of the biggest revolutions of this decade, at least as far as the fund management industry is concerned. And why this becomes even more important is because the returns that even the traditional fund management products, which can cost you anything from 2 to 3%, an ETF can probably cost you as little as 0.1 or maybe as much as 0.5, 0.6. So this movement from mutual fund to ETF is probably one of the biggest revolutions of this decade, at least as far as the fund management industry is concerned. And why this becomes even more important is because most bullish of economists and fund managers, which they expect from the next 10 years, are a pale shadow of what we had in the last 10 years. So last 10 years, starting from a very low base, whether it was the bonds or it was the equities, practically all asset classes, real estate, other alternative assets, they've all given humongous returns over the last 10 years. But we do not expect these kind of returns to happen over the next 5 to 10 years. So it was still okay to pay 2% or 3% when you were making 15% gross on your investment. But if your returns are probably going to come down to maybe 5, 6 or 7% an annum, then to pay 2.5 or 3% is absolutely brutal. So this is where ETF, in our opinion, are going to become the investment of choice for the biggest of family offices, for the biggest of investors, and for the biggest of funds in the world. We believe that an era of no entry and no exit load is already upon us, but we also believe that many of the fund managers are still living in the past. They are probably still living in the 20th century, and they are in denial mode. They do not want to acknowledge ETFs. They do not want to consider no entry and no exit loads as even an option, because obviously there are vested interests involved. When you are tied down to a product in the form of entry and exit loads, usually the objective is to enhance remuneration by holding you down there, to enhance remuneration for the fund managers and for the wealth managers. But we believe that with the coming of age of ETFs, it is going to be of paramount importance that in future the number of products that come with entry and exit loads should actually be less than 10% of the industry, and rest of the industry should welcome you with open arms and with an option to get in and get out at any time at the NAV without any other costs attached. We also believe that the time has come when the fund managers should make money if you make money. So at a time when we believe that the difference of returns from between a successful investor and a not so successful investor, that performance is going to be so stark. So unless and until the fund manager proves his mettle and proves that he or she is worth it, and that they are able to outperform the indices and they are able to deliver positive returns to their investors, which are superior than the average returns, or at least better than 60 to 70% of the funds in that category, then they should be able to make this an option to you, that you should be able to get in, get out at any time, that you should be paying them the higher fees only if they make the grade and if they are in the top 10% or in the top 20-25%. But if they are somewhere close to the average or below average, they do not deserve to make any extra returns apart from recovering their costs. We believe that time has already come, but we also see that a lot of the fund managers are still in denial mode. So it will probably take some more time for them to get used to this. But this is a role which you as investors can play. If you start posing these questions to your fund managers and wealth managers, chances are that they would see the logic of this and they would also gradually bring down their fixed costs and go more variable depending on the returns. Lastly, on this side, the ESG norms. So now it is becoming more and more common to see investors who are very aware and conscious of the fact that their investments should not hamper or cause they should not cause any environment or social distress. They want to be on the right side of environment. They want to be on the right side of society, and they want that their investments, while of course being profitable for them and working for the economy, they should also work in favor of environment and in favor of society at large. So this is also a change that we are seeing in the industry, and we believe that you as investors are playing an extremely important role in this, and you should continue your efforts in this direction. And it is a pipe dream for us that over the next few years, all of us are going to become, as investors, more and more conscious of the environmental and the social concerns. We now come to the next part of the presentation, which is the revolutions happening in the wealth management industry. So we believe that the wealth managers should now expect a much less return on assets on their client assets. So this norm used to be at 1.25, 1.5% till a few years back. But now we believe that with the ETF proliferation and with lower expected returns in the future, we believe that wealth managers have no business to charge you that much. So the cost should be definitely it should be under 1%, probably close to 0.5%, and maybe with an added incentive only if they outperform the other wealth managers and if they generate an alpha for you over the normal returns which you can expect from a good wealth manager. That's the only situation where they should get anything more than the small minuscule asset management charges which they get. And secondly, we believe that the time has come when there should be no conflict of interests between the wealth manager and the client. But unfortunately, it is still happening that the wealth manager would try to sell you products where, apart from the usual fees that the wealth manager gets, they also get compensated by the manufacturer of that product for selling his or her product to the end investors. We believe that if the wealth managers continue to persist with this practice, this is already leading to and will lead to huge conflicts of interest, where you would want investments which can give you the highest returns, and they probably want to sell you the investments where, apart from their usual return on assets, they also get kickbacks from the manufacturers. We believe that the time has come that the wealth management industry gets this absolutely straight, that this is not going to happen anymore. And as investors, you are the ones who can make this happen. Another complication which happens in today's time, which was not so common in previous times, is that today an average client has assets in multiple geographies and across multiple asset classes. So, today our audience has a lot of IT engineers and IT bigwigs, who have given us this privilege to interact with them today. And as IT engineers or as IT service providers, today it is very, very common for an IT professional to have assets in multiple parts of the world. One is their home country, and other could be the countries where they hop from time to time to make a living for themselves. And similarly, what applies to individuals also goes for businesses, family offices, funds, institutions, everybody. So the time has come where wealth managers stop adopting a regional approach to managing assets or managing wealth, and rather they focus on the global opportunities. It doesn't matter which geography the client is coming from or which geography his or her assets are located in. But today, in this globalized world, it is an opportunity and also a challenge for all wealth managers to be across the globe and to spot opportunities and discover opportunities all across the globe and bring it to the attention of their clients and actually help them make them a part of their portfolio. Multiple asset classes. So today, the alternative asset classes have come up with such huge vengeance over the last few years and probably the last decade or so, that today the normal choices are no longer just the bonds, the equities and the commodities. Today it is also about the AIFs, it is about the hedge funds, it is about commodity related products, it is about structured products, art, wine, so many of them. So we believe that just like a wealth manager has to be global in their approach, they also have to be asset neutral in their approach, and they have to have the capability to check all the assets out, see their viability, expect their returns, and then, if viable and profitable, make them a part of the client's portfolio. Last but not the least, as part of this wealth management, we believe that the opportunistic management of jurisdictions is also now becoming an important part of this practice. because you have different taxes in different parts of the world, and to the extent that the client's assets are located in different countries, by optimizing the jurisdictions, you can actually economize on the taxes. And this is also a task which completely lies on the shoulders of the wealth managers of today. And we believe that as part of this initiative, all of us should ask our respective wealth managers if they are doing justice to us on this front, and if they are being global, asset neutral, and also helping us to get our assets in the right jurisdiction and to get our assets the lowest tax rates that they deserve. The next part is the changes and the revolutions which are happening in the wealth preservation industry. So wealth preservation is all about maintenance of assets, movement of assets, transmission from one generation to another, intergenerational planning. And there are quite a few changes which are happening here. So the biggest one is the expanding tentacles of estate taxes and duties. So there was a time when this used to happen only in the Western world, but now many Eastern countries are also in the process of launching estate taxes of their own. This would mean that as citizens of that country, or as having assets in a particular geographical location, now we have to be mindful of the fact that we need to navigate this territory in such a way that we either avoid paying estate taxes, or we at least minimize them through the handling of this tax jurisdictions part. Then, of course, there are the client's assets are in multiple geographies, which mean that as wealth preservers, when you make your trusts, you need to be mindful of the fact that the laws are different, the taxes are different. So multiple taxes would either mean multiple trusts or at least multiple treatment in the same trust. So this is again something which your family office or your wealth managers or your wealth preservers, they need to be very mindful and conscious of. Then, of course, as families get smaller, the complications keep getting more complex and things keep getting more complicated. So right from an increasing divorce rate to this live-in relationships being almost like marriage, but they have different legal status in different countries. And then you could have your children in different countries. So basically, when you make your trust structures for the transmission of wealth from one generation to another, again, we need to be extremely mindful of this. Last but not the least, there is this increasing awareness that we've seen in many of our wealthy family office clients, as well as corporates, as well as wealthy individuals, that they want to at least devote some percentage of their wealth for charities. And we believe that if you are also moving in that direction, that this is also another service which your wealth manager or your financial advisor should help you with, to be able to channelize your money across different charities in the causes that you believe in different parts of the world. The next part of the presentation is about PACE 360. We call ourselves the revolutionaries, and we believe that we are at an opportune place at probably the right time, because most of these revolutions and historical and watershed developments that are taking place in the finance and the industry world, we believe that we are on the right side of them. And we'll just run through how we effectively we are trying to cope up with all the challenges and developments that we've shared with you, and how we intend to sort of work with you and work with all our existing family office clients, so that we can collectively, we do better as an investment and wealth manager combination, and we are able to do justice, and we are on the right side of history and revolution. We believe that all of the wealth managers who are probably going to be on the right side of these changes will probably make history, and those who are not will probably become history. So whether it is our wealth management, or it is our fund management, or wealth preservation, we essentially hope to provide you one-stop shop for all these different needs. So basically, we try that our clients do not have to go to any other third party, either for fund management or for any one of these aspects, or to get a hold of different asset classes, or to get a hold of assets in different geographies. We hope to provide you all with our best services under one roof. We are absolutely committed to the bare bone cost, which we believe is absolutely essential if our investors have to be profitable, even in the low expected return scenario, which we think will probably pan out in the next few years. We have a completely global focus. We are present in about 58 countries where we channelize our clients' investments. And these 58 countries cover about 97% of the global market capitalization of all financial asset classes. So essentially, we are actually trying to cover all possible asset classes and all possible geographies for you in our quest for optimizing the returns for you. There is absolutely zero possibility when it comes to conflicts of interest. We are a 24-year-old entity, and till date, there is zero evidence of any conflict of interests, any scams, or anything negative about us in the media or anywhere else. We do not believe just in the legal right or the technical right. We also believe in moral right and spiritual right. And unless and until we are convinced that we are actually morally right and spiritually right, we do not take any of our decision-making processes forward, which is why we believe that there is a very good chance that we are going to meet your expectations that you have as far as our ethics and value systems are concerned. There is going to be no entry load, and there is already, whatever products we have, none of them have any entry and exit loads, and that is the way it is going to be. And across all our products, this is an important condition. We make money when you make money. So we just recover our basic minimal costs as part of our fixed charges, and rest everything and anything comes to us only if we outperform the expectations that are very well set out at the beginning of the relationship. Now I come to the last part of this presentation, which is about the relevance of this entire these historical changes, these evolutionary changes that are happening for the IT professionals, and how they should make use of this higher knowledge and superior consciousness to basically navigate and negotiate with this extremely challenging environment, which has already posed in front of us, and things are probably going to become more challenging and not less. So we believe that most of the IT professionals that we have interacted with, they either believe in DIY, which is do it yourself, or they go to their neighborhood banks to basically to make the entire arrangement more convenient for them. We believe that DIY is not a great option in the time to come, because the complexities, as pointed out, are now so higher, and the complexities are so many more that we need to maximize the intellectual capital and the knowledge and the consciousness in the entire exercise. And DIY, in our opinion, means that we are sub-optimizing on the knowledge and the intellectual capital. So you should try and expand the capital rather than reduce the intellectual capital that is available to you for all your financial decisions. Of course, and then the market volatility is going up, and it is going to go up even more significantly from here. Then today you need a 24/7 research focus to monitor everything. The sudden and cataclysmic changes in the investment world are so stark. And the one common example that I can probably talk about is the Trump tweets. And you know how things can suddenly change for all asset classes with those Trump tweets. So basically, unless and until there is somebody who's full-time watching everything for you, we believe this is not going to be a viable option anymore in future. Last but not the least, as far as the global marquee banks are concerned or your neighborhood banks are concerned, we believe that conflicts and scams have become so extremely common. You are obviously aware of the PPI scandal in UK, which is probably going to be worth about 30 to 40 billion dollars. So in the last 20 years, there have been innumerable scams. Every year, every 2 years, there are new scams which come up from the same players. I don't know how many times they will be forgiven for this, for whatever they have been up to. But what we believe is that the time has now come that we become more differentiated and we start using the highest moral principles when it comes to deciding who is going to manage our wealth and who is going to manage our money. And plus, of course, they come with a huge bundle and baggage of costs, which we believe is going to render the entire exercise in any case unviable for you over the near term and even the distant term. So now I come to the end of the presentation, and we would have a Q&A session, and I'll hand over the mic to Baton to Kanika to take up the rest. Thank you.
Thank you, Amit, for the insightful presentation. We are now open for the Q&A. And the first question is by Abhishek from France. Please provide your view on trade wars.
Yeah. Thanks a lot, Abhishek. That's a very interesting question, and we need to be mindful of this, that even in the past, trade wars, whenever they've happened, they have actually affected the asset classes and the asset allocations, the optimal asset allocations a lot. And this time is no different. As pointed out earlier, this time the trade wars are probably here to stay. And we believe that while there could be some short-term agreements, some short-term understandings, but the fact is that whether it is US and China, or it is Japan and Korea, and of course whether it is North America and Europe, so this is now pretty much a global sort of a phenomenon. We believe that this trend is expected to continue, in some ways probably get worse, and this obviously poses a big challenge for us as wealth managers and fund managers. So overnight, a company can simply lose its customers because of duties. Overnight, a country's balance of payments position can be challenged because of the trade wars. Overnight, a currency change can happen, like we discovered a few days back when Chinese yuan depreciated by about 2% in a single day. So not only is this something which is here to stay, but also I think this will have a ramification and impact on our asset classes. But this is not the only moving target. So at any point of time, we are watching literally hundreds of economic and financial variables to decide what would be the optimal investment. So the slowdown, the sectoral performances, the movement of the interest rates, the balance of payment positions, the inflation, so everything. So there are so many things that go into all these economic and financial decisions, that while it is very difficult to exactly single out the impact of one phenomenon on all asset classes, but together they all sort of act on one another and make it ever more complicated. But we believe that now we have models which can probably take care of many of these complications going forward. Thank you.
Thank you, Amit. The next question is by Anupam from London. And the question is, what is your view on the impact of Brexit on the markets?
Yeah. So, Anupam, of course, UK is not what it used to be till about, let's say, 70, 80 years back, or even 20, 30 years back. So in the overall scheme of things, UK is now a much smaller economy, which is probably less than 2.5% of the global GDP. But having said that, UK is a very, very important investment destination, a business destination, a hub for the entire European market. And all those things are changing as we speak. So not only has it become extremely uncertain for the businessmen to now decide where to locate their companies, where to locate their manufacturing plants. There is a lot of uncertainty as to what the taxes between UK and EU trade are going to be, whether they are either going to be in a customs union or they are going to levy normal tariffs on each other's products and services. So on top of every other uncertainty that is panning out in front of us, this just adds to one more complication. So what we believe is that because of Brexit, pound has already suffered a lot. So from a level of about 1.45, which it was before Brexit, we are already at about 1.22. We don't believe that pound has much more to go down, probably another few percentage points at max. And then probably pound will recover from here. We believe that in terms of UK real estate, yes, there has been an impact on this on the commercial real estate prices in London. That is absolutely a matter of fact, and it will continue to do so in future. As far as the stocks are concerned, it is basically the impact on stocks comes from two things. The impact on the currency, which affects the competitiveness of stocks and indices in different parts of the world. For example, UK stocks have actually done better because of the depreciation in the pound, because of many companies on FTSE. They are MNC corporations, and their overseas earnings become more valuable in pounds because of the depreciation of the pound. So all these factors will probably play out. Our base case scenario is that Brexit will happen, but we are still not, it's still not 100% baked in as far as we are concerned that it is going to be a hard Brexit. We still believe that there is still a possibility that this may not be a completely the hardest possible Brexit, and we believe that the majority which the current Prime Minister and his party enjoy is so slim that there is a possibility that maybe another elections are called, or maybe this Prime Minister has to resign before the due date, which is 31st October. So while this pans out, markets have sort of almost discounted that that there is going to be a Brexit, and there is going to be a very, very hard Brexit, practically a no agreement Brexit, in which case UK and EU will be just like any two different regions, and they will have to negotiate on their taxes and tariffs and everything, just like they will do with other parts of the world. So while the markets have discounted this, we are slightly different. Our base case is that there is as much a probability of of some sort of either because of the government change or the fall in the government, there is a possibility of a softer Brexit. So we would say it's a 50-50 thing. We are watching it very closely, but either which ways, we like pound as a currency, and we believe that it is probably going to become an attractive currency over the next couple of months. Thank you.
Thank you. And the next question is by Parikshit from Norway. And the question is, what are your expectations from global or US equities over next year or two?
Right. Thank you, Parikshit. So we believe that equities are probably they are probably not the best asset class if we have a few years in horizon. On the other hand, probably they have just taken a beating in the last few days after the US-China wars became a lot more serious. So there is a possibility that markets may become sideways for some time, and we believe that there would be a flight towards quality. This rally would become, this global equity bull run would become narrower as we go ahead. And there is a possibility that a few chosen companies in each country would probably do a lot better than a vast majority of the listed companies. So that is a possibility. And we do not expect a very big fall in equities in the very, very near future, we expect them to be largely sideways. But over the 2-year horizon, we are bearish on the markets because of various factors that we've talked about. We still believe that a global slowdown is already underway. We still believe that there is going to be a beginning of a recession, probably if not in 2020, maybe in 2021. And markets being forward looking, they would usually discount a recession much before it already happens. And right now there is this disconnect between the bond market and the equity market. The bond market is suggesting that we are straight away heading into a recession, while the equity market is suggesting as if the corporate bottom lines will probably hold and the economy is essentially going to hold. We believe that this disconnect will sort itself out one way or the other. Probably there is a very high likelihood that the bond yields will go up from here. We believe that bond yields, long-term bond yields have practically bottomed out in all parts of the world. So bond yields go up from here and equities largely become sideways in the near term. But for us now, on every major rise, we believe that it would be an opportunity for the investors who are already loaded up on equities to gradually reduce their weightage on global equities and to gradually come into the safety of other asset classes. But those other asset classes also have to be chosen with a lot of caution, because after this huge rally, there is a possibility that bonds may not continue to do well, rather they may fall in value. So overall, it's a pretty tough situation. It's a tough challenge to negotiate with, but we do believe that equities are probably sell on rallies from now onwards. Thank you.
Thank you. The next question is by Mark from Poland, and the question is, what information do you need from us to take over our portfolio?
Wow. Thank you, Mark. Thanks for asking this question. And obviously, it's on a slightly different tangent, and I really welcome that opportunity that you've given. So essentially, we are into a totally customized and a personalized mechanism of wealth management. We are believers in AI, but we are not so avid believers of AI and automation in wealth management. We believe that most of the AI models the last 10-20 years sort of baked into their models, and that is what they use to predict the outcomes, and that is how they basically recommend you as to how you allocate your assets or how you allocate your money between different assets. But that is not where we are. So we would want to understand all your portfolio dimensions, your exposure to all global asset classes. We would obviously do a profiling in terms of your risk profiling and your cash flows, your future cash flow projections. Apart from that, this is a very, very customized thing. This is not a model-driven wealth management model, basically. So at any point of time, based on your needs, your requirements, your risk return outlook, your profiling, we would continue to make changes to your portfolio in order to make sure that not only is the portfolio at all times in sync with your risk return profile, it is also in sync with what we believe is going to happen to different asset classes over the next 3 years, 5 years, and 10 years. So our approach is very long term, but we monitor the markets very closely to see if the markets have begun to take a turn, because all long-term changes, they start from short-term events or short-term changes. So at any point of time, we would be in a two-way engagement process with you, and we've got our own questionnaires for the profiling. But apart from that, there are a lot of other things that go into our proprietary model, which we would keep we would request you to share with us from time to time so that we can optimize decisions for you as far as your asset allocation is concerned. Thank you, Mark.
Thank you, Amit. The next question is by Yarden from Israel. And the question is, which currencies are you bullish on for the next few years?
Wow, thanks, Jordan. Currencies, by the way, is my first love in fund management industry, because we've been doing currencies for about 22 years, and that has usually been a happy hunting ground. So effectively, what we believe is, Mark, that dollar index is in the process of topping out. We believe that dollar index, which was at about 78, 79 in 2014, is already at about 98, and it recently made a high of very, very close to 99, and it made a high of about 103 in January of 2017. So what we believe is that dollar index has essentially topped out. And usually, if you see European and US currencies, they move in 8-year cycles. So, so the last time when euro was at 1.6 was in about 2008, which was 11 years back. So this particular cycle has already overstretched. So this bullish dollar cycle is now about 11 years old. And we believe that this dollar rally is more or less coming to an end. There is a possibility that as the bond yields go up in US, which we expect them to, the dollar index might continue to be range bound for some more time, maybe a few more weeks, maybe a couple of months. But if you ask me as to what's going to happen over the next 2 to 3 years, I would probably put my money on Japanese yen, euro, CHF, which is Swiss franc, and probably even pound, once we believe that a no agreement Brexit is absolutely 100% baked in, and we believe that there is absolutely no downside left in the pound. So we are bullish on European currencies. We are bullish on Japanese yen. But the caveat I would like to make here is that this may not happen immediately. So while dollar index is trying to make a top and the European currencies are probably in the process of making a bottom, we need to be cautious as to how we make an entry into this market, because if in the currency market, if you're trading on thin margins, then a small movement can actually deplete your capital big time. So we need to be extremely cautious. But long term, we are bullish on European and Japanese currency, and we are extremely bearish on emerging market currencies for the next about, I would say, a year. So we believe that there has been a huge rally in emerging currencies between last year September and this year July. And we believe that emerging currencies over the last 2 weeks have more or less topped out against US dollar. So emerging currencies are going to depreciate against dollar, and dollar over the long term is going to depreciate against Japanese yen and the European currencies. Overall, it's going to be a very, very exciting landscape on the currency side. And I would be more than happy to be in touch with you and share our evolving views on currency from time to time. Thank you.
Thank you, Amit. The next question is by Ankit from New Delhi. And the question is, need your views on likely withdrawal proposal of government on the higher surcharge for FPIs.
Okay, so it's back to Indian markets. So, of course, I think this higher taxes on FPI did play a role in the huge correction that we witnessed in the Indian markets over the last few weeks, effectively since the budget day. But that is not the only reason why that has happened. We believe that the fact that the budget was not the most reformist budget that one could have expected, considering the huge challenges on the economic side that India is facing, whether it is our auto complete slowdown and in fact a depression in the auto industry, or it is about our consumer durables, or about our banking, or about the meltdown in the NBFC space, or our low capital investments on the private side. So we have been suffering from many economic imbalances in the last, I would say, a year or so. And the only reason why GDP has not gone down a lot worse is because the government spending was pretty robust all this while. So there are many reasons why that correction happened from the top, wherein your Nifty came down from 12,000 to about 10,800, 10,900 levels. Now there is, of course, this talk of reversal of that stance on higher taxes and FPI. We still don't know exactly how things will pan out over the next few days, and we still need to be more informed on this. But what we believe is that if the government were to take back its stance from the budget on FPI taxes, it probably will give way to a relief rally. But I still doubt that we would go all the way to the top again, because the other issues are extremely serious, and the challenges in front of the Indian economy are probably more serious than in many other parts of the world. So while there could be a relief rally, but I would probably use that relief rally to probably take some money off the table than to invest more money. Though we do believe that some of the small caps and mid caps, not the overall space, but some of the small caps and mid caps on a very selective basis, they have become hugely attractive because of the way all of them have been painted with the same brush. So we would probably nibble at them, but we would also probably use this rally, if that materializes further, to actually encash a little more. Thank you.
Thank you, Amit. Dear participants, this is the last question of today's session. And the question is by Nitin from Sweden. The question is, what will be the right asset allocation mix for the next 3 to 4 years?
Thank you, Nitin. That's a great question, and that is what it all boils down to. So it's the proverbial $1 trillion question, so to say. So all the challenges that we've talked about in the last an hour or so, they all point out to the fact that while it is going to be extremely exciting and interesting, it is also going to be a very challenging task to allocate assets for the next few years. And we also believe that the difference in performance from a brilliant fund manager to a mediocre fund manager was never so stark as we are going to witness over the next few years. So effectively, this is what the entire presentation and this entire effort is all about. So what we believe is, Nitin, that gold is a very viable and a very good asset class to hold over the next few years. We believe that gold has started a new long-term bull run, and usually gold bull runs do not last for anything less than 6 to 7 years. We believe that this will also last about that much, if not longer. And we believe that the prices, which were as low as $1,260 in April, where we turned extremely bullish on gold, they've already climbed up to about $1,500 an ounce. But we believe that this is just the tip of the iceberg, and they will probably move up to about $7,500 to $8,000 an ounce. And the impact in terms of some of the emerging currencies would be even higher, because while this happens, we also expect emerging currencies to depreciate by anything from 20 to 40%. So the impact in terms of some of the emerging currencies could be as high as 1 to 10. They may go up 10 times. The gold may go up 10 times from here in those local currency terms. So effectively, we believe that gold should be anything from 10 to 20% of every portfolio from every individual or any family office as well. That's probably one of the most important classes where we would want to allocate your assets in. Then we like to keep ourselves a little liquid to take advantage of the distressed opportunities which just throw themselves up from time to time. Like we mentioned about the US 20, 30-year bonds last year, who've seen a huge rally. So from the low point to the high point, US 30-year bonds have moved up by about 30%, and that's in less than a year's time. No other asset class, no other big asset class in the world has done as well as the US long tenure government bonds over the last 8 to 10 months. So we try to take advantage of these distressed opportunities, and we like to keep ourselves 20% in liquid cash to be able to take advantage of such opportunities as and when they come by. We are extremely bearish on emerging markets, both debt and equity. So that is not where probably we are going to put too much of our money right now in. Equities, we would probably start with maybe a 30-40% allocation, but as we move up in this rally or as we go sideways, we will use this consolidation, or we will use any rises or any rallies to actually reduce our weightage on equities a lot more than they are at this point, because we are not bullish on equities over the next 2 to 4 year time frame. We are still bullish on US long-term bonds for the long term, but I think they have suffered from deluge of investments rushing into them over the last few weeks, because of which we have taken this opportunity to book profits, and we would probably be waiting for a little while to again go up strong on this asset class. So if 10-year yield moves up above 2%, right now it's about 1.72. So if it moves above 2%, we'll probably load up on the US long tenure bonds again. We are going to be extremely thin on high yield debt, because we feel that a lot of defaults are going to happen, and this could become like a mini subprime crisis for the next few years because of the sheer extravagance with which a lot of debt has been issued by private equity players, by companies who were doing acquisitions, and even for paying dividends. So I think that will all come home to roost. So that is not where we want to go in. We would probably be in government bonds of developed market currencies. We would want to be in European currencies and not in emerging currencies, or even in North American currencies. We would want to be in agro commodities, because we believe that agro commodities have suffered near decimation over the last 7 years. And last when we checked, we still all needed food to survive. So we believe that food industry cannot suffer for much longer the way it has in terms of the agro prices of all agro commodities and even livestock and your other similar food items. So what we believe is that we are going to go big on agro. We are going to go big on bullion. We are going to go big on US long-term treasuries, but not right now. After a certain while, we would leave our 15 to 20% cash for taking advantage of distressed opportunities, and we keep the entire approach extremely dynamic, so that from as the situation changes or evolves in the economic or the political system, we are usually fleet-footed enough to change the asset allocations from time to time, even though the approach is very long-term. So this is how probably your portfolio and your wealth is going to evolve, if you give us an opportunity, and we would do our level best to make this process as interactive for you as possible. Thank you so much for this question, and I thank all the participants yet again for giving us this opportunity to be a part of this exercise and to share knowledge and consciousness with all of you. We are indeed grateful. Thank you so much. And now I hand over to Kanika.
Thank you, Amit, and all our dear participants for this interactive Q&A session. For the participants whose questions couldn't be answered due to paucity of time, we regret the inconvenience, but please be rest assured, and our best of the responsives shall be wired into your respective inboxes. And that brings us to an end. I sincerely appreciate all of your time and attention for joining us from different parts of the world and making this webinar successful. We truly appreciate your continued support. We shall look forward to your participation in our upcoming webinars as well. We shall keep you posted. Thank you and have a nice day.